For decades, mutual funds dominated the investment world. But over the last 20 years or so, they've been challenged by a young upstart, exchange-traded funds, or ETFs. ETFs have some similarities with mutual funds, but also some key differences. Like a mutual fund, an ETF is a portfolio of stocks, bonds, or other investments. You can buy shares in it to get exposure to all the investments it holds. Both mutual funds and ETFs offer easy ways to build a diversified portfolio. Here are some of the differences between the two fund heavyweights. Mutual fund shares are priced just once a day. Shares of ETFs trade all day long, just like stocks. Another difference, it's easy to just buy one share of an ETF. Many mutual funds require minimum investments as high as $3,000 or more. Mutual funds may be actively managed, meaning a manager selects the particular investments he or she likes best. Or they might be index funds, which means they just try to represent a particular section of the market by tracking a broad index, like the Dow Jones Industrial Average. Very few ETFs are actively managed. The vast majority track indexes, such as the S&P 500. Finally, ETFs tend to cost a bit less to own. Their management fees tend to be lower, and they offer certain tax advantages. So how can you use ETFs to build a portfolio? Start by thinking about diversification. The more variety you have in your portfolio, the more chance you'll benefit when certain areas of the financial markets rise, and the more protected you're likely to be when other areas run into trouble. You want exposure to both stocks and bonds. In general, the longer you have until you need your money, the more it makes sense to invest in stocks. Your stock investments should include shares of large and small companies of all industries in the US and in foreign markets. You can get that diversification by investing in a single broad ETF, or you can piece it together. For instance, you could invest in one ETF that holds a broad collection of US stocks, add another that invests in international stocks, and then finish off your diversified portfolio with a broad-based bond ETF. You may want to add small investments in more specialized options as well. For example, ETFs that hold emerging market stocks, specific types of bonds, or even alternative investments like commodities. Investing doesn't have to be complicated. Tools such as ETFs can make it relatively simple to build and maintain a diversified portfolio.